Hi everyone, welcome to this introductory training on the Crypto Asset Reporting Framework, better known as CARF, or as our North American colleagues like to pronounce it, CARF. This session gives a bird's eye view of CARF, what it is, what it's meant to achieve, and in very, very broad terms, how it works. The first and most obvious question to anyone wanting to know more about CARF is, what on earth is CARF exactly? On one level, CARF is just a book, the book depicted on this slide. You can get a free PDF of the book at the website shown on the slide. If you look at the CARF book's main title, you'll see that the book deals with international standards for automatic exchange of information in tax matters. We'll get to what that means later in this training, but first take a look at the subtitle, and you'll see that CARF, which is of course short for the Crypto Asset Reporting Framework, isn't even the entire book. The book is about both CARF and an update to the so-called Common Reporting Standard, which is more commonly known as CRS. We'll talk a little bit later about CRS and how it relates to CARF, but for now let's focus just on CARF itself. As its name makes clear, CARF is a reporting framework related to crypto assets. More specifically, CARF requires certain individuals and entities who provide crypto asset-related services to report their crypto asset customers and the crypto asset transactions that those customers engage in. That's the very big picture. There are lots of details, nuances, exceptions, and qualifications that we'll get to later in this training and in other trainings. But that broad description is what CARF's all about. Reporting related to crypto asset transactions and individuals and entities that engage in those transactions. The very next logical question is, what exactly is CARF's goal? It's pretty straightforward actually, to prevent crypto asset owners from evading taxes by hiding their crypto assets. So that's the very, very broad view of what CARF's about and what it's designed to achieve. In the remainder of this training and in the other trainings in this series, we'll put a lot more flesh on those very bare bones. In this training, we'll also introduce you to some of CARF's key terminology. We've listed some of the key terms on this slide. However, because this is just an introductory training, for now we'll merely introduce these terms. We'll do a deeper dive into almost all of them in later trainings. The other trainings in this series of trainings are listed on this slide. Each training builds on the one before it. Our goal is that after you've completed all of the trainings, you'll know enough about CARF that you can implement it using the resources available on carftools.com. If you're not already a subscriber to carftools.com, you can subscribe on the website. You'll be given the option to subscribe to all of our resources, including all of the trainings, or just the resources that you need. If you're looking for even more in-depth information, please check out our 5-part series of articles called Old Tricks for New Dogs. You can get copies of those articles in both text and podcast formats on the website shown on this slide. Now let's dig a little deeper into what CARF's really all about and how it really works. Since CARF is a crypto asset reporting framework, it's obviously essential to know how CARF defines crypto asset. CARF's definition of a crypto asset is very broad. We've put the definition on this slide. If you look at the definition, you'll see that it's full of what many people might describe as technobabble. For example, it uses terms such as digital representation, cryptographically secured, distributed ledger or similar technology, and so on. Fortunately, you don't have to be a crypto expert to realize that the definition is not limited to cryptocurrencies such as Bitcoin, Ethereum, Dogecoins, and the like. No, the definition is couched in intentionally broad terms and captures other things as well, such as non-fungible tokens, more commonly known as NFTs. Now, tokenized assets such as digital versions of bonds, shares, and derivatives, warrant a special mention. Due to both the CARF FAQs and the Common Reporting Standards' own FAQs, many of these fall outside CARF because they are now included in the definition of financial assets under the Common Reporting Standard and are regulated under that regime. However, unless certain conditions are met, some tokenized investments are covered by CARF. There are some exceptions to the types of crypto assets that CARF is interested in. For example, while the three types of assets listed on this slide are all crypto assets under the broad definition that we saw on the previous slide, they are nevertheless excluded from CARF. First, CARF is not interested in central bank digital currencies. If a government creates its own digital currency, it's up to that government to police that particular crypto asset. CARF doesn't tell governments how to do that. Also excluded are so-called specified electronic money products, which are basically digital versions of fiat currencies, in other words, regular currencies, used for making payments and that are created by private outfits. Now, it's possible that some so-called stable coins will fit into this exception. However, due to some technical requirements of specified electronic money products, most stablecoins probably aren't excluded. In other words, most stablecoins don't qualify as specified electronic money products and are therefore included under CARF. And finally, crypto assets that can't be used for payment or investment purposes are also expressly excluded. Tax authorities are not interested in digital assets that can't be used to buy things and that don't go up or down in value. Crypto assets that don't fall into any of the three excluded categories on the previous slide are called relevant crypto assets. It's only relevant crypto assets that CARF is interested in. In other words, CARF covers all crypto assets other than the three types listed on the previous slide. Now let's consider who the lucky people are who have to file CARF reports. They're called Reporting Crypto Asset Service Providers, which is abbreviated as RCASP and which many people pronounce as RCASP. We won't get into who qualifies as an RCASP in this training because we've got another whole training devoted to just that topic. For now, though, think of an RCASP as any individual or entity that provides services related to exchanging crypto assets, either for money or for other crypto assets. Now, what about the even luckier people who actually get reported under CARF? These are RCASP's customers. CARF calls these customers crypto asset users. However, because nothing is simple under CARF, there are some exceptions. In another training, we do a deep dive on which customers are and which are not crypto asset users under CARF. But to keep things simple for now, just think of all crypto asset customers, whether they be individuals or entities, as being crypto asset users. Now, here's a very important point. Just because someone is a crypto asset user doesn't mean that they necessarily get reported. Crypto asset users who get reported are called reportable users. To be a reportable user, a crypto asset user has to be resident in a country with which the RCASP's country has a CARF Information Exchange Agreement. You see, CARF is a cross-border reporting framework. That doesn't mean that countries aren't concerned with crypto asset users within their own borders. To be sure, many countries have already established domestic reporting requirements for local crypto asset users, but CARF itself is solely a cross-border reporting framework. It's not only reportable users who get reported under CARF. CARF also has a special rule that requires RCASPs to look through certain crypto asset users that are entities and identify the entities' so-called controlling persons. Now, if you know anything about CRS, you'll know that there's a similar look-through rule under CRS. The purpose of this rule, just like under CRS, is to prevent individuals from hiding behind entities so as to avoid being reported. We do a deep dive into CARF's look-through rule and controlling persons in another training, So we won't get into any more detail here. For now, just be aware of this look-through requirement. Also, just as with crypto asset users, only controlling persons who are resident in countries with which an RCASPs country has a CARF information exchange agreement are subject to CARF reporting. Now just a clarification about some more terminology. Reportable users and reportable controlling persons are collectively known as reportable persons under CARF. Now let's look at what actually triggers CARF reporting. Merely owning crypto assets is not enough, nor is being resident in a CARF partner jurisdiction. It's only when crypto asset users engage in transactions with their crypto assets that reporting is triggered. CARF calls the specific transactions that trigger reporting relevant transactions. We get into what is a relevant transaction in another training, but for now, just know that relevant transactions are of two main types. First, exchanges of crypto assets, whether for money or other crypto, and second, transfers of crypto assets, including transfers used to buy non-crypto assets. So far we've covered who has to do reporting, RCASPs, who's reportable, reportable users and reportable controlling persons, collectively called reportable persons, and what triggers CARF reporting, relevant transactions. But what does CARF reporting itself actually entail? Well, first, it's an annual requirement, not a one-and-done exercise. An RCASP must file reports every year, at least so long as at least one of the RCASP's customers has engaged in at least one relevant transaction. Some jurisdictions may even require RCASPs to file a so-called nil report in years for which none of their customers engage in any relevant transactions. It's up to each CARF country to decide whether it wants to impose a nil reporting requirement or not. Reports are filed on an RCASP's country's own CARF reporting portal and are disseminated from there to the countries where the respective reportable users and reportable controlling persons reside. As for the details of CARF reports, well, as with a lot of relationships, it's complicated. In fact, it's insanely complicated. I won't bore you with any of the details here. Another entire training session is devoted to just what details actually get reported under CARF. Now a word about CARF due diligence. If an RCASP is going to file accurate reports, it obviously has to collect accurate information, including, for example, about its crypto asset users and controlling persons' identities and jurisdictions of residence. So CARF imposes very specific due diligence obligations that RCASPs must follow, and RCASPs must base their reports on these due diligence processes. Thankfully, CARF's due diligence procedures are relatively simple. With very few exceptions, due diligence under CARF requires that RCASPs get so-called self-certifications from their crypto asset users and controlling persons. RCASPs have to determine the reasonableness of the self-certifications and have to get updated self-certifications if relevant information is inaccurate or has changed. We won't get into any more detail about CARF due diligence here because we do that in another training. Now let's return to the CARF book itself. As the book's main title makes clear, first, CARF is an international standard. It's an international standard because it's being implemented in dozens of countries around the world. It's also an international standard because, as already mentioned, it applies only to cross-border, not purely domestic reporting. Second, CARF relates to automatic exchange of information. It's an automatic exchange of information because it doesn't require tax authorities to ask for the information. RCASPs must file annual reports without being asked to do so by any tax authority. Third and finally, the information exchange relates to tax matters because, as we've seen, CARF's whole purpose is to prevent tax evasion. You can find a list of countries that have committed to implementing CARF on the website on this slide. The list is updated periodically, so always be sure to check the website whenever you want the most up-to-date list. As of the 4th of December 2025, 48 countries had committed to begin exchanging CARF reports as early as 2027. CARF reports are backward-looking. In other words, the reports filed in 2027 will contain information about transactions engaged in 2026. That means that RCASPs in the so-called early adopter countries who will exchange reports in 2027 must begin collecting data on their customers and their customers' transactions on the 1st of January 2026. Therefore, CARF really begins in these countries in 2026, not 2027. If you look at the list of countries that have committed to implementing CARF, you'll see that it includes all EU members, although Cyprus is implementing CARF 1 year later than the other EU countries. Also, the EU has actually adopted its own unique version of CARF, which is referred to as the 8th Directive on Administrative Cooperation, or DAC 8 for short. DAC 8 is largely a clone of CARF, but does contain some EU-specific differences. So think of the EU as having adopted CARF, but with some unique twists. Now take another look at the CARF book. As you can see from the logo in the lower right, it's a publication of the OECD, which is short for the Organization for Economic Cooperation and Development. The OECD is an international organization that's headquartered in Paris and is funded primarily by its member countries, currently numbering 38. All current OECD member countries are so-called developed countries. You can find a list of OECD member countries at the link on the slide. In addition to the CARF book, the OECD has also published a list of CARF frequently asked questions, or FAQs. You can get a copy of the OECD's CARF FAQs at the website on this slide. The FAQs are updated periodically, so always check the website to get the most current version. One very important point. The OECD's CARF book and FAQs are not laws. Both are just publications of a non-governmental organization with zero legal authority. CARF becomes law when, and only when, a country adopts legislation incorporating CARF into local law. And of course, sovereign countries are free to incorporate the OECD's CARF book word for word, or to make changes as they see fit. As we've already seen, the EU version of CARF is not an exact clone of the OECD's book. Nevertheless, based upon what most countries have done under CRS, it's likely that most CARF countries outside the EU will implement CARF with only a few, if any, variations from the OECD's book. However, a trap for the unwary is to treat the OECD's publications as the CARF Bible and to fail to check local legislation to see whether they change some of CARF's requirements. Always check local legislation, regulations, guidance, FAQs, and similar materials for the authoritative version of CARF in a particular country. Before we end this training, let's recap what we've covered. CARF requires RCASPs to conduct due diligence on their crypto asset users and on the controlling persons of certain entity crypto asset users. RCASPs reports are based upon the information the RCASPs uncover through that due diligence. CARF reports must be filed every year and are triggered when an RCASP's customers engage in relevant transactions. Only individuals and entities that are resident in countries with which the RCASP's country has a CARF automatic exchange of information agreement get reported. Those reports are sent to the RCASP's home country's tax authorities, who then share the reports with the countries where the respective crypto asset users and controlling persons reside. That, in a nutshell, is how CARF works. As mentioned at the outset, this is just the first in a series of trainings about CARF. The other trainings are listed on this slide. You can access additional trainings by subscribing to CARFtool.com's entire suite of resources or to just the trainings themselves. If you have any questions at all about CARFtools.com or any of our resources, please visit our website or feel free to email us at info@carftools.com. Last but not least, the lawyers make us show you this copyright slide and remind you that copying this training or any part of it is strictly prohibited. That's it, folks. We hope you found this training both interesting and enlightening. Thank you for taking the time to work through it.